Hello and welcome to Livewire's Undiscovered series, where we'll be shining a light on some of the market's under-the-radar funds. I'm Ali Selby, and today we're very lucky to be joined by T. Rowe Price's Peter Bates for his outlook on global equities and some of his favourite stocks for today's markets. Thank you so much for joining us today, Peter. Really excited to have you all the way in Sydney from the US. Thanks.
Yeah, thanks, Ali. Great to be here.
Okay, let's talk a little bit about the past. Global equities have obviously had a really strong 12 to 18 months, but it wasn't so long ago that investors were avoiding them like the plague. What are some of the key lessons you've learnt during those 2 or so years of volatility, and how have they set you up for today's markets?
Number one is COVID just created COVID and the monetary response to COVID created massive distortions and bubbles that have effectively popped. And I think that's what created a lot of volatility in the market, because when the federal government increases the money supply by 30%, that money's going to find a home, and that money inflated all assets. And it's now early to mid 24, and I would say the COVID distortions are now finally kind of getting out of the economy. The second thing I would say is the market has no clue on where interest rates are going to settle, because we're still waiting for where inflation is going to settle. And I would opine that I think the next 10 years could be completely different from the last 10 years because of the changes that have happened in the global economy that link to inflation and interest rates.
Do you want to dive a little bit deeper into that? How do you feel like the market will be different over the next 10 years?
You know, I started my career at T. Rowe Price in 2004. And 3 or 4 years in, we had the global financial crisis, and that was linked to U.S. subprime housing and a massive recession that created a massive Fed stimulus response and massive bank problems, because banks had a bunch of problem loans, houses were underwater with equity, and it really created a slog of an economy, and it led to 0 or negative interest rates. And we basically had 0 or negative interest rates from 2010 to 2020. And what that led to was reasonable nominal economic growth, but pretty good real growth. And with low rates, the growth class of companies that could grow marginally faster than the nominal economy got extreme valuations, whether you were profitable or not. And I think in the next regime, where instead of having inflation of 2 with nominal growth of 4, which leads to real growth of 2, I think you could have nominal growth that's still 4, but inflation that's 3 or 4, which leads to lower real growth, but also higher interest rates. And when you have higher interest rates, you have a cost of capital, which means valuation matters more, and there's not as much kind of cheap money flowing in the market.
Okay, we'll get into a little bit more of what that means for equities, but I want to talk about your strategy. What's unique about your investment process?
I think what's unique about my process is different than the strategy. So first, what's unique about the strategy is T. Rowe Price. I appreciate this as an interview for new emerging funds, but I am part of an aircraft carrier of an organization. T. Rowe Price is a massive global enterprise. We manage $1.5 trillion. I am basically incubating a new business within that infrastructure, but I am building that business off the back of our massive research platform that is roughly 150 plus analysts globally, roughly half in the US, half outside the US. So number one, what's unique is I'm harvesting the best ideas off that platform. I own about 35 stocks, and I think our investment in that resource is a competitive advantage. Number two, the market automatically assumes concentration equals high risk. I would argue my strategy is lower risk than funds that have 2 or 3x the holdings, because of the way I manage it to balance factors and balance cyclical risk. And number three, what's unique is the 1 plus 2 that I just mentioned lead to uncorrelated alpha for people who invest with me.
There's some experts who argue that the US has run far too hard on AI optimism, and some have likened it to the 2000s tech boom and bust. Do you agree? And if not, why?
Yeah, I do not agree. 2 main reasons. So I wasn't professionally investing in the tech boom and bust, but I was investing. And some of the companies that were the big .com winners were either unprofitable, tech or they were companies that were using leverage to help build their business. And so when interest rates went up because the Fed started raising rates, I think it was like 2000 that the Fed really started to raise rates, that added a cost of capital that hurt the ability to borrow money and spend. Right now, all the AI tech funding is coming from companies like Microsoft, Amazon, Apple, Google, Meta. These are trillion-plus-dollar companies that have like $100 billion of cash on the balance sheet. So these AI investments aren't being funded by debt, they're being funded by cash. And I think the table stakes for the next decade winners are driven by who wins in AI. And so if you're in the Microsoft boardroom and you're talking about investment spending, you're not cutting AI because that would be foolish because you're positioning the company for the next decade. And those same discussions, I think, are happening at Google and Meta and whatnot. And all those companies just reported earnings, and most of them are raising CapEx. And I think it's AI driven. So that's number one, that the balance sheet of the spenders is totally different. Number two, so much of the dot-com boom was laying fiber. And once you lay fiber, you don't need to lay it again. You just need to wait to use it. Where the AI investments are not like dormant capacity, where the AI chips and hardware that is coming out, primarily from NVIDIA, is getting better. So the chip you buy tomorrow is going to be better than the chip you bought yesterday. And so much of long-term winners with AI is going to come down to compute cost and who can run inference at the fastest rate, at the cheapest price, and part of that is electricity utilization. And so I think that perpetuates the CapEx. Fiber was very different. We built so much fiber in like 98 through 2000 that it took us like a decade to consume the fiber.
Okay, it sounds like you're quite bullish on AI.
I am. I think it's definitely an emerging technology, and when you think of just society, it's pretty wild seeing it happen. I have a go-to Chinese restaurant in my neighborhood, and it's like a mom and pop where you can tell it's like a first or second generation family. And I was ordering food a month or two ago, and it took me halfway through my order to realize I'm talking to a robot. And when I asked the computer, I said, "Am I talking to a robot?" "No." And I'm like, "What's your name?" There's like a second pause. "Karen." And I'm just like, wow. And so when I went in and picked up the food and I talked to the owner, she's like, "Yeah, we have a service that does this and it costs us a certain percent of sales." And I just thought that was fascinating. And it even had a Chinese American accent.
Wow.
With the language model of the robot. So pretty wild. Yeah, things are changing.
Okay. How are you actually invested in AI though?
There's a handful of companies, and I think what is amazing and creates an opportunity for active management is it's not 100% clear who the winners are long term with AI. We have a philosophy of who they are, and there's definitely things we're looking for, but it's definitely evolving. And I think over the next 5 years, you're going to be able to look back and say, man, if we just could have known this, it's obvious you're going to win. So we are working very hard with all our analysts and sector managers and portfolio managers to try to identify the criteria that leads to future victory. We have a handful of things right now that we think, but again, it's evolving. But I think it's some of the big tech companies right now because they're investing in the CapEx and the hardware to develop these models and have the compute cost where you need it. So I own Amazon, NVIDIA, and Microsoft. And then on the software side, it's companies that can easily embed AI into their software to make it cost more. And I think that's the first kind of step towards monetizing AI. And so I own, Microsoft is obviously a big software company, but I own a couple other software companies that we think have the opportunity to embed this AI and then charge more for their product.
Okay, another thing that's really taken the market by storm over the last 12 to 18 months has been GLP-1s, or those weight loss drugs like Ozempic. Do you think that theme has further to run, and are you invested there as well?
I am. I own Eli Lilly. Basically, these GLP-1s are controlled by two companies, Novo in Europe and Eli Lilly. I own Eli Lilly over Novo because I think they have the best oral coming to market. They also have a more diversified pipeline with other things that are coming. Calculating the addressable market is very difficult. and the addressable market for these drugs is exploding. And so I think it's worth giving Lilly and Novo time as stocks, even though right now they are optically expensive, because what we're finding is if you lose 20 pounds, a lot of your other health issues get better. And that has implications for how many knee replacements you need, how many hip replacements. Obviously, if you're diabetic, losing weight helps, blood pressure, heart stuff. So I'm bullish, and ironically, Lilly reported last night in the States, and I was just reading our analyst, and they're raising estimates, and really the constraint to growth is the capacity to produce the product. And I have a friend in America who has been using the product, and he had to stop taking it because he couldn't find it, meaning pharmacies were out. So I don't know how prevalent the products are here, but they're coming, and they are really kind of miracle drugs. I almost feel like we're cheating nature, like this is a bad sci-fi movie or something. But frankly, these products have been around for like 10 plus years. So if there was like a nefarious side effect or something, I think we would see it by now.
Does feel like we're in an episode of Black Mirror with the weight loss drugs and AI and everything.
So normally in life, you can't like cheat hard work, right? How do you lose weight? You exercise, you eat less food. Well, these drugs help you lose weight, and they curb your appetite, and there doesn't seem to be a bad side effect.
The same could be said for AI as well, I guess. It helps you
it could,
work easier.
Yeah, it's pretty, I don't know, it's pretty exciting. I mean, I'm almost 50, and my kids keep me young, which is kind of cool. But yeah, just seeing the change that's happening, it's pretty wild.
You're also bullish on US housing, infrastructure and reshoring. Can you explain that investment opportunity to us and how you're invested there?
Sure. So, boy, I started at T. Rowe in 2004, and really for 15 years, and it really started in 2000, it was outsourced to China, low cost, right? And some of it was happening in Mexico, a lot of it was happening in China because China had massive excess labor. And this concept of part of low inflation, low interest rates was China was exporting deflation because, I don't know, in America, Walmart is a big store. I'm sure there's Walmarts here, but there's not. Okay.
No.
So I'm sorry, I need to get more current with Australia. But you could go to Walmart and buy stuff so cheaply because it was being made in China. And what that did, labor costs in China were literally like $5 a day versus $10 an hour. I mean, this is 20 years ago in the US, and that just led to massive cost deflation for all these things that consumers buy. But what it ended up doing is gutting the industrial manufacturing economy in the United States. Obviously, and this is partly why I think inflation the next 10 years can be higher than the last, is the world is not such a friendly place anymore. And companies have learned partly from COVID, where if different countries have different COVID policies and they shut down factories and your only factory is in China and China's shutting down for COVID, you've got a problem. So you see diversity of supply chains, but you also see for geopolitical reasons like, maybe we shouldn't make everything in a country that might not be friendly. And so I think a lot of that means we need to bring things back to North America, whether it's Mexico or the United States. So what does that mean? More investment happening in infrastructure, which is good for steel. I own a stock called Steel Dynamics. More freight and transport activity happening. I own a company called Canadian Pacific, Kansas City Southern, which is one of 2 railroads that goes into Mexico to bring things north. And I think we've also underinvested in U.S. housing. So the U.S. housing stock is incredibly old. So houses either need to be repaired or completely rebuilt. And when you look at demand for housing, it's exceptionally strong, and prices are up because we don't have enough homes. And I own a company called Stanley Black & Decker that makes DeWalt power tools as well as some other things that are used in the construction of homes.
Okay, in your latest market update, you talked about being overweight durable growers right now. Can you outline what a durable grower is and take us through a high conviction idea that would fit into that category?
Sure. Attributes of durable growers are things like recession resilient. You don't have big drawdowns in EPS, and you have steady recurring revenue that allowed you to build a business and gain operating leverage on your cost to have profits grow faster than your revenue base, and you have a long runway for growth. So when you ask about, wow, durable growers, what's an example of one? I immediately think of Danaher. Danaher is a company I've been involved with for over a decade, and they are a life sciences biopharmaceutical company that sells the equipment and the tools you need to make and test a lot of the new drugs that are being developed and used by the healthcare industry. And you had a massive bubble in spend from COVID. That bubble has unwound because people aren't using vaccines as much. All that spending has come down. That has kind of pressured Danaher earnings the last, I'd say 2 years. Earnings have been flat to modestly down because COVID revenues of $3 billion went away. You're now bottoming and about to enter a phase over the next 5+ years where I think Danaher can grow the top line 6 to 8% and grow EPS 10 to 15% annually over that 5-year period. And you're trading in a valuation that is not demanding at a mid-20s PE multiple. And actually, part of an attribute of a durable grower that's a good company is your cash conversion on earnings is high, which signals quality EPS. A lot of companies kind of overstate EPS with accounting games, but the match that EPS is good is your cash flow on that earnings. And Danaher's cash is in line to ahead of earnings, so it's actually a little bit cheaper when you look at the free cash flow multiple.
Okay, I think I'm going to wrap up the interview there. It was such a pleasure to speak with you today. We don't often get to interview people from the US and learn about global equities, so I'm really grateful. Thank you so much.
Great, thank you.
If you enjoyed that too, don't forget to subscribe to Livewire's YouTube channel. We're adding so much great content just like this every single week.